Okay. So we'll be looking at the next topic. So broadly, we are doing financial management. We are in the process of trying to understand what are the different risks, major risks, okay, financial risks that a company or a business can encounter, and two major risks in terms of the finances that we are talking about is one is forex risk if you are involved in import and export, and the other one is interest rate risk or interest risk. So we looked at foreign currency risk last week. Okay, we'll try to understand what this interest rate risk is, okay, today. So before we go into the interest rate risk, we have to understand a few things about how interest rates work. Okay, combining with our knowledge of present value and future value. So let us talk about, let's say, an instrument. Okay, let's say a bond. Okay, now, okay, even before bond, valuation of any asset. Okay, valuation of any asset, any project you have seen in financial models. How do you do valuation? You do discounted cash flow valuation. You discount all the cash flows. Okay, so valuation of any asset, this is an underlying principle within finance, that valuation is the present value of all the future cash flows. Okay, this is given, like that is how you calculate your NPV and all those things. Okay, this is across all the asset categories. Very simply, whatever are the cash flows associated with that asset in the future. Okay, this year, next year, after 2 years, 3 years, 4 years, 5 years, indefinite time also we consider, perpetuity also we consider. So the present value of all the cash flows of that asset, okay, net present value becomes the valuation of that asset. Okay, so if that be the case, then those instruments, okay, those instruments or those financial assets and liabilities which are linked to interest rates, okay, which are linked to interest rates, for example, where the return is mainly in terms of interest, okay, then those are in principally impacted by the movement of interest rates. Okay, now if I'm holding a stock, if I'm holding equity shares, that is not directly impacted by interest rates. It is impacted by the movement in the prices. Interest rates, yes, it will impact in the long term, very long term, but over a short term or generally interest rates will not impact the price of the stock, even though directly. Okay, even though there is interest rate is also one contributor to the movement in the prices, but not a major component. But whereas let's say loans or investments, fixed deposit investments, bonds, these are few things which are directly impacted by interest rates. Okay, these are few things which are directly impacted by interest rates. For example, the valuation of equity. Okay, again, present value of all the cash flows that equity will have. Whatever cash flow that company is going to earn, present value of that cash flow. Valuation of bond. Okay, present value of all the cash flows associated with the bond. Okay, so now we understand that, okay, to determine the present value, we understand that to determine the present value, we need something called as interest rate, right? We need something called as return, basically that interest rate. Okay, the measure. This is also called as yield. Okay, to determine the present value. Okay, we need to know the basically these are used as discounting factors. Okay, so let's talk about a bond, how a bond works. Okay, we say, for example, 1,000 rupees bond. Okay, with 8% coupon rate, 1,000 rupees bond with 8% coupon rate, maturing after 3 years. Okay. 1,000 rupees bond means what? Face value of the bond is 1,000 rupees. Okay, with 8% coupon rate maturing after 3 years. Okay, my required yield is, let's say, 10%. Okay, calculate the value of this bond. What does a coupon mean? Coupon means, what does coupon mean? What does coupon mean here? Coupon means the cash flows, the interest that comes. Okay, not interest, but the cash flows associated with the bond. 8% coupon means every year you will get 80 rupees. Okay, so that is the cash flow. What are all the cash flows? 80. Then when the maturity happens, how much you will get? 1,000 rupees. So that is a cash flow. Okay, so these are the cash flows. What is your discounting factor? 10%. So calculate the NPV. Calculate the net present value. Calculated present value. Pavitra.
Sorry, 882.
888.
882, sir.
Any other number? Anyone? Take it. It should not take so much of time. Simple calculation. So year 1 cash flow 80, year 2 cash flow 80, year 3 cash flow 80 plus 1,000. So it will become 1,080. These are the cash flows that you are getting, okay, from the bond. Then discounting factor. How much? Huh? 0.9091, 0.824, 0.75, 13. Discounted cash flow 80 into this. Total is 950. Pavitra, how did you get 882?
Sir, I put Excel formula, sir. That 18,000 I have put separately, sir.
1000 you have put separately. Yeah.
Yes, sir. Excel formula I have put it, sir.
Okay. Okay, no problem. Now, this is basically the present value of all the cash flow. So what we are telling, the value of the bond today is 950.244. Now, if you apply your amortization logic here, if you apply the amortization logic, okay, what we have seen in amortized accounting in your leases, same thing, everything is same stuff only. So if I tell opening balance, how much is opening balance? 950.244. Interest at what rate? At 10%. This into 10%. Okay. Repayment, how much? 80. So closing balance. Okay. Then this becomes the opening balance for second year. Interest 80. Closing balance. Then this becomes the opening balance for the subsequent year. Interest, repayment, closing balance 1000 rupees. This is at the end of the third year. So everything is same. Now, what I wanted to discuss, or what I wanted to focus more importantly, is on the discounting rate. Okay, now this 8% coupon cash flow, this is not interest rate. Even though we can call it as at the rate of you're going to get coupon in terms of 8%, this is a cash flow. This is also a return in terms of your investment. You're getting 80, this is also a return of cash flow. So that is why we are considering. Okay, point one. I'm telling my required yield is 10%. Okay, I'm telling my required yield is 10%. So that is why we are associating a value of 950. Now, if in the market the price is 980, will I buy this bond? I will not buy this bond. Because these are quoted instruments, these are also quoted instruments, right? This may be quoted, this may not be quoted. In the market, the price is shown as 980 for some reason. Okay, but my valuation is only 950. That means I will not buy this bond. Why? Because the return from this bond will not be equivalent to 10% or more than that. It will be less than that. So if you have to calculate IRR based on this, if you have to calculate IRR based on this, so minus 980, 80, 80, 1080. These are the cash flows, right? And you have calculated IRR in your financial models. So if I say IRR, what is the percentage I'm getting? 9%. So if you also calculate using your formula, okay, whatever we have discussed in the class in the weekdays, you will get this number. Okay, so that means this bond is giving me only 8.8%, whereas my requirement is 10%. Right? So I will not go with this bond. Okay. Point. That means the yield. Okay, now if the effective yield from this bond is how much? 8.8%, not 10%. 10% is what I require. My required rate of return is 10%, but this bond is giving me 8.8%. This is the yield that this bond is giving. Okay, are we understanding? This is the return that this bond is given. Okay, all simply your present value and future value calculations, no rocket science. Okay, now, so what we do, okay, in terms of interest rates, to understand the interest rates is we try to look at the benchmark rates. Okay, now this benchmark rate could be government securities, okay, RBI bonds. Okay, in the US we call it as treasury bonds. Okay, we also call it locally as gilt securities. Okay, which are basically interest free. I mean, risk free. These are risk free. Okay, these are risk free investments in the respective markets, like say treasury bonds in the US. Okay, RBI bonds or any government securities or RBI bonds in India. Okay, these are generally risk free. So what I do is I try to find out, okay, for maturity. Okay, now we should also understand, tell me which bond is more risky in terms of maturity. This bond is 3 years, another bond is 10 years maturity. Which bond is more risky comparatively? A bond with 3 years maturity or a bond with 10 years maturity? 10 years or 3 years? Why? Here the years? Sure. So you put money in an investment, this investment will return after 3 years, another investment will return after 10 years. Huh? No, no. Returns is a different thing. I'm not asking about risk. Everything else being same, 3 years investment and 10 years investment. 10 years. Why? Because of the uncertainty. Here my uncertainty is for 3 years. The political risk, the economic risk, the default risk, right? All type of risks are only for 3 years. But in the other bond, everything is for 10 years. I have to wait for 10 years. So generally, okay, I will prefer investment with a shorter maturity. And that theory is called as liquidity preference theory. That means investors seek liquidity. They expect liquidity. Okay. Now let's say, so there are bonds with, so because the risk is high, the maturity also, the the returns will also be high. A 3-year bond and a 10-year bond, I will seek a higher return because the risk is high. So then I also put yields here. Let's say 3%, 4.1%, some random numbers, 5.2%, 5.85%, 6.1%, 6.6%, 6.9%, 7.2%, 7.8%, let's say 10%. Okay. Now, what is this? This is not like yield of a 10-year bond. In the first year, you're getting 3%. No. These are different bonds with the different maturities. Okay. Bond A with 1 year maturity will give you yield of 3%. Okay. Another bond with 4-year maturity will give you a yield of 5.85%. Okay. Understand? So what I do is I try to put this in a graph. Okay. So I put this in a graph. Okay. Now this curve, okay, generally this is a line, okay, connected. Okay, I'm not getting a yield graph here in this Excel, but generally this is a line, okay, a curve. We call it as yield curve. Okay, so this yield curve is what yield curve is going up or coming down. This is upward sloping curve. We call it as upward sloping curve. So what an upward sloping curve tells? So this is the maturity and this is the yield. What an upward sloping curve says, as the maturity increases, the return will also increase. Now let's say this will be okay. So now you see what is happening. The curve is like flat and then suddenly it is increasing. It can also happen like this, where it increases suddenly. Okay, and it can also happen like this. What is happening? It is decreasing, then increasing. Now this is a, you can say, V shape. This is a V curve. Okay, where it decreases and increases. Now it can be in any form. Okay, normally we see it as an upward sloping curve. If it is decreasing, if it is downward sloping, then there is a recession. Why? Because interest rates are not growing. Interest rates are coming down. So if interest rates are coming down, that means loans are cheaper, deposits are not attracting any investments, right? That means people are not willing to buy more. That means economy is not doing well, right? So that is a downward sloping curve. So how does it matter to us? How does it matter to a finance manager? So he will always look at this different benchmarks. He will look at the yields, different yields. Okay. So the chart will not be as simple as this. Just try to take some of the charts. So now look at this. This is okay one of the yield curves. Okay, and one of the types of bond. Okay, euro dollar bond. Look at how the interest rates are behaving. Right. So this okay. I think this tweet was 1 week back or so. Okay. So 1 week back, let's say today, this is how the rates are behaving. And this was about 1 month back. For example, a 3 month implied rate, 3 month euro dollar, okay, 3 month LIBOR, 3 month euro dollar rate is around 2.92 today. The yield is 2.92. Okay. The next maturity after September will be January, right? October, November, December, 3 months. That rate is 3.4. Then again, it is coming down, implying that the rates are decreasing. These are yields with different maturities, right? A 3 month bond or a 3 month interest rate maturing in May 2023, okay, or May 2024, or September 2024, something like that, right? These rates are decreasing from 2.92, it went to 3.4, then it is coming down to 2.44, right? These are the expectations. These are not the actuals. We are talking about the forecast. What is the expected trend in interest rates, right? Where are the interest rates going? Okay, like 1 month back, the forecast was this. If I take this today, let's say, let me check whether I can get this Europe. Okay, anyways, I'll get this. So basically what we are telling is, so how do I how do I use this? Let's say as an individual, as I want to take a home loan. Okay, now I'm not going to say this, right? Individuals will not say this. Like, okay, I want to check whether the interest rates in India are going to increase or not. Right? So what is the trend? Right? What is the trend in the past and what is the expectation? So for example, RBI recently increased the rate, right? The rates were decreasing for last 2-3 years. I remember in 2015-16, the rate, home loan rate used to be 9%, 9.25%, something around that. And in 2020, it came down to around 7.5%. And until recently, it was hovering around 6.8% and all. Now it is back to 7%. Right? So that means in last 3-4 years, it was in, like say in 2017, 18, 19, it was decreasing trend. And now it is in the increasing trend. So next 2-3 years, 4 years, we may see that the rates will only increase. It will go to 8%, 9%. So those who buy home loans now, take home loans now, will pay higher rates. They will pay higher rates. And those who have taken home loan in 18, 19, and their home loan is going to continue for next 10 years, 15 years, they are also going to pay higher rate only, because the interest rates are going to increase, right? If I have taken home loan at 7%, rates are going to be somewhere around say 8.5% in 2 years, 3 years time, and this will continue for say next to 5, 10 years. That means I took a loan at 7%, but I'll be paying at 8.5%, which is almost 20% high. I'm going to pay 20% higher interest cost. Right? That means I'm expecting the interest rates to go up. Right? So that is what a finance manager also does, or a treasury function also does. They will look at what is the forecast. Okay, where are we expecting the interest rates to go up? How is the yield curve behaving? If the yield curve is behaving like this, that means we are expecting the interest rates to come down. Okay, but now there are a lot of interpretations. Okay, who determines this yield curve, how it works? Now, yield curves that are representing government securities are correct, right? If someone is forecasting on some other benchmark security, then not reliable. That is more subject to speculation. If you are relating it to risk-free rates, okay, government securities, then it is okay. For example, look at this. So look at this. US 1 year yield is 2.8. Then 2 years, 2.99. 5 years, hovering around same. 10 years, hovering around same. 20 years, what is happening? It is going up. And 30 years, what is happening? It is coming down. So this person is telling odd how the 20 year is the highest point. Right? That means you are telling my interest rates will go up, then come down. How do you expect? Again, 5 years, 10 years, okay, but how do you forecast it 20 years? And in today's terms, it is very, very difficult to forecast. Okay, we cannot forecast for next 3 months. Forecasting for 30 years, 20 years is only it's not even a speculation. Speculation, at least you have some information. Right now, 20 years, who can forecast it today? No one knows what is going to happen in next 3 months. Right? It becomes very, very, and never have been people able to predict. But these are the rates. Okay, these are the rates trading today. So if I'm investing in a 20-year bond, I'll get this rate today. If I'm investing in a 20-year treasury security, I'll get this yield. Okay, tomorrow it may change, but you are investing at this rate. If you are investing at 30-year, you'll get 3.139. Okay, so this is about your yield curve. Okay, how your yield curve works: upward sloping, downward sloping. Upward sloping means it will increase, and also that curve. Okay, that curve, at what point that curve occurs. Okay, like whether it is very steep, whether it is slopish, right? So all those things also matter. That is like further deep into like this subject. Okay, we call it as fixed income, and more of economics also. So out of our scope, I think little bit of more is discussed in your AFM. So when you come to AFM, we'll discuss more about okay the curveness of the yield curve. Okay, basically a steep curve, okay, a broad curve, okay, how it, what does it mean? Okay, so simple statistics. So here we have to understand what is yield curve, what is upward sloping, what is downward sloping. Yield curve is a curve, it is a line, okay, it is in the nature of a curve, okay, or it comes as a curve, okay, where you are plotting maturity of different years and what is the expected yield on the bonds of different years maturity. Okay, so through this I try to determine okay whether the interest rates are going to increase or decrease. Then as a finance manager, I can decide. I can decide on what is the next course of action going to be. Are we getting this? Anyone has any doubt? Okay. So what is the risk that I'm having? As far as interest rate is concerned, there are two types of risk. One, I'm having interest linked liabilities. Then I'm having assets which are interest linked. Meaning to say, I'm having investments where interest is a key factor to measure the returns. Okay. Similarly, liabilities, say I'm paying interest. Okay. So now I'm having liability one, okay, liability two, liability three. Similarly, which are interest linked. Okay. Similarly, I have asset one, asset two, asset three. Again, these are also interest linked. Okay. So what I do is, as a finance manager, as a treasury manager, I'll try to now in real world I will have thousands of these different loans, okay, which I have taken, or thousands of different loans which I have given. Okay. So what I will try to do is I'll try to club those exposures, okay, by maturity, right, by risk or by category, mainly in terms of maturity. So I'll classify the loans where the maturity say 1 year, then 3 years, 5 years, some random maturity. Similarly, assets also I will classify. I'll classify this three, okay, something like this. No, it is not that 100% I'll be able to offset. Agree? It may not be possible. Okay, it is not. It is just not possible. Where you will be able to correlate one to one, and you will say, okay, I have liabilities worth of 5 million maturing after 3 years. I have investment worth 5 million maturing after 3 years. Not possible. You cannot do business like that. Okay, so that means I have loans with a maturity of, let's say, 5 years. Okay, this is maturity. Let's say 5 years. I have loans worth, let's say, 10 million, and I have assets worth 8 million. Okay, so if interest rates, when will I be in a favorable position? Okay, question is when I will be in favorable position. Okay, when interest rates increase or when interest rates decrease. In this scenario, in this case, when will I be in a favorable position? Interest rates? Why? Hmm. So indifferent. Why?
Because you have uh, loans worth of 10 million and assets worth of 10. When interest rates increases, you will get like you will spend more for loans and you will get income for loans. It will offset, so it will compensate.
How it will compensate? How it will compensate? Are you getting my question here? Think I am a bank. Okay. For a bank, what are the loans? Deposits. Right. And for bank, what are the assets? Loans. Okay. So here I will liability and assets. Okay. So a bank has 10 million worth of deposit from public with 5 years maturity, and it has given loans to public worth 8 million. Okay. So when will it be in a favorable situation if the interest rates for the bank increase or if the interest rates for the bank decrease? What is the net exposure? 2 million. Liability or asset? Liability. That means I have to pay interest on this 2 million. That means if interest rates increase, I have to pay more interest. Right? If interest rates decrease, I have to pay less interest. Right? So you have to see, that is what we call it as gap exposure. Is this gap positive or negative? It is negative. Right? If it is negative, then interest rates should decrease. Negative exposure, right? The gap is negative. That means you are paying more. Right? So that means if you are paying more, if you are paying, you have a net liability then your interest rate should come down so that you pay less interest. Vice versa, positive, meaning to say my assets are more and liabilities are less. In that case, my interest rate should increase. Okay, so that is what we call it as gap exposure, negative gap and positive gap. So the language used in your material is little complicated. Okay, a negative gap occurs when interest sensitive liabilities. So you have to understand what your material mentioned talks about. Okay, same thing, whatever we have just discussed. A positive gap occurs if the amount of interest sensitive assets. What are interest sensitive assets? On whichever assets that are impacted more by interest movements. Okay, so interest sensitive assets maturing in a certain period exceeds the amount of interest sensitive liabilities, not all liabilities, those liabilities which are getting impacted more by interest rates. At the same time, in this situation, the firm will lose out if interest rates fall by maturity. Right? If the interest rates decrease, I may lose out. Why? Because I'm having net positive exposure, positive gap. Able to understand this? So this is the normal yield curve. So upward sloping, normal. Downward sloping is called as inverse. Right? As the maturity increases, the rates decrease. So downward sloping or inverse yeah, inverse yield curve will give a result, or we are expecting a recession to happen. We don't expect the growth to happen. Very simple. If an economy is growing, that means interest rates will also increase. Right? In a normal economy, there will be normal inflation, and normal inflation will contribute to higher interest rates. Right? We have seen interest rates, Fisher effect. How interest rates are made up of? Interest rate is made up of what? Inflation plus real rate. Okay, real rate, which is risk-free rate, real rate plus inflation. That means if there is a normal inflation, okay, then it is good. That means economy is growing. Okay, at a nominal rate, at a normal rate. Okay, so if interest rates are increasing, that is a sign that the economy is growing, but not like too much. Okay, then that becomes hyperinflation. Okay, say a situation in like Sri Lanka or generally in most of the countries in Africa. Okay, where that is a hyperinflation. So we're not talking about that. We are talking about normal movement in inflation that will cause normal movement in interest rates will increase. Slowly they will increase. However, if it is decreasing, that means the growth is not there. This is a simple economics concept that we have to understand. Everything is based on this principle only. So there are, as I said, the expectations as to why interest rates change. The expectations are liquidity preference theory. What is the liquidity preference theory? I have a preference for shorter term securities rather than longer term securities. Why? Because I will get money quickly. Right? Everyone wants cash. Right? The more quicker I get the cash, the bigger preference I will give to that option. Okay, expectations theory, basically the expectation is that interest rates will keep increasing, and then there is market segmentation. Again, there are different players in the market. In the short term and in the long term, the interest rates will differ. Okay, so these are the factors which cause the yield curve to change. Okay, otherwise if there is no other factor, interest rates will remain flat. Right, whatever be the maturity, whatever be the term, whatever be the risk, the interest rate will remain flat. But that will not happen. Why? Because we have different expectation, and different players have different expectation. Two expectations are common. One expectation is liquidity, that I need money quickly. So if you are going to delay money, then you have to compensate me adequately. Right? Higher the maturity, higher the risk, so higher the yield or higher the return. Okay, then the expectations theory is in the normal scenario, inflation will increase, that will cause the interest rates to increase. So these two theories, okay, these two theories mainly liquidity preference and expectations theory cause the curve, the yield curve to change and to increase. Okay, upward sloping. So you can go through the content on the yield curve. Okay, so now we know that, okay, I have a positive gap, I have a negative gap. Okay, all these things are okay. What next? How do I manage this risk? So this is what we saw in FX also. First, we tried understanding what is the FX risk, right? How it comes. Okay, so what are the FX risks? Three types of risk. Huh? Transaction risk, translation risk, and economic risk. Okay, so similarly, interest rate risk also we have seen. Okay, how it comes. Okay, when you have net exposure. Okay, whether liability or asset. Okay, if the rates increase, it could be favorable or it could be unfavorable. So whatever, whether favorable or unfavorable, still you are exposed, right? And most of the businesses will have interest sensitive assets or interest sensitive liabilities. Okay, no business will be there which doesn't have interest sensitive assets or liabilities, right? 90% of the companies have borrowings. Okay, most of the companies will have borrowings. There are very few companies which do not have debt. Okay, so if most of the companies are having borrowings, that means most of the companies are having interest sensitive liabilities. That means most of the companies are exposed to risk of interest rate risk, and interest risk is a huge risk. Okay, because 90% of the companies are sustained on debt, right? That means everyone has a debt, right? And because everyone has a debt, interest rate risk becomes a major risk. Why? Because you have to repay the debt, you have to repay the interest. Whether you get business or not, whether you make profits or not, you are bound to make interest payments, right? So if you don't do business, if you don't make money, then you are in trouble. If you have borrowed money, right? That is why this risk becomes a major, very, very big risk. Okay, even if I don't have borrowings, even if I don't do business, even if I'm not making revenue, even if I'm not making profits, it is okay. Okay, but if I am having loans and if I'm not getting business, if I'm not able to make money, then it is a bigger problem. Okay, so how do we manage this risk, right? So you had some tools to manage the FX risk. We have similar tools to manage this interest rate risk. Okay, how do we manage this risk? Anyone has any doubt? Okay, now there are a few ways, okay, how you manage this risk. Okay, first let me talk about swaps. Okay, we have something called as interest rate swaps. This is a derivative. These are one form of derivatives. So what happens? Let's say I've taken a loan. Company A, bank. Okay, I've taken a loan from bank of, let's say, okay, loan at 8%. Okay, I've taken loan at 8%, and I have to pay interest. Right? Let's say this is a fixed rate. Okay, this is a fixed rate. That means I'm going to pay interest at 8% whatsoever. Okay, now there is something called as floating rate. What is this floating rate? Huh?
Day by day.
It will keep changing based on what? Based on what? Hmm? Based on certain benchmark rates. Okay, based on certain benchmark rates. Okay, now this benchmark rates are generally decided by the central bank of any country. Okay, like for example, we have something called as PLR. Okay, which banks are advised prime lending rate. So what will happen when you take a home loan? Okay, bank will say your rate will be PLR plus 0.5%, PLR plus 1%. So this 0.5% or 1% once agreed, that will not change. Okay, the PLR can keep changing whenever bank changes, RBI changes interest rates, and consequently, your bank decides to change the rate. For example, you will see that okay, RBI has increased the rates, RBI has decreased the rates. Within 2 days, you will see news HDFC increases the prime lending rate by X amount. Okay, or by X basis, 50%, 0.5%, 0.25%. SBI increases the lending rates by so much, or deposit rates by so much. Right? That is nothing but changing the PLR. So PLR is something that will keep changing. Okay, the international version of PLR is called as LIBOR. What is LIBOR? London. What is LIBOR? London Interbank Offered Rate. Okay, so this is something decided by, say, Bank of England. Okay, the central bank of England, in tandem with say 20 participants, different financial institutions, different banks. On a daily basis, they will meet, they will agree. Okay, what is the 3-month lending rate? What is 6 months lending rate? What is 1 year lending rate? What is 2 years lending rate? What is 5 years, 10 years? Okay, what is 15 days lending rate? Lending among themselves, lending and borrowing among themselves. So that becomes the benchmark rate. And that keeps changing every day. Okay, every instance it will keep changing. Okay, so how the banks work? Okay, in Europe and in the US, okay, LIBOR plus X%, that becomes the floating rate. Okay, so now LIBOR is moving out. There is something called as sterling overnight index average. Okay, which is replacing LIBOR. Okay, we call it, this is short form is SONIA. Okay, sterling overnight index average. Okay, because both are same. It is just that the way LIBOR is determined and the way this is determined is different. Okay, so this will become the benchmark rate in some time now. Okay, I'm not very sure whether. I think it is already in place. So benchmark, it is a forward looking risk free reference rate. Okay, what is this, Sonia? Sonia is this risk free reference rate available in 1 month, 3 months, 6 months, and 12 months tenor, denominated in pound sterling and designed to be an alternative to LIBOR. Okay, will they test this in exam? No, but you should know a little bit about the financial markets as far as Europe is concerned. So what is happening in UK now? Then Hmm. Okay, and Indian. Okay, not an Indian. I think he was born there only, but he's having roots here. Rishi Sunak. Okay. So you should also a little bit understand about the financial markets, what are happening in the financial markets in Europe, okay, and in specific, mainly in London, okay, UK. So what happens now? Let's come to floating rate. I'm company A, I am expecting the interest rates to come down. Okay. My equation, I look at the yield curve and I feel that interest rates may come down. Okay. So then what is my problem? I'm having a loan, I'm having a net gap, positive gap or negative gap? Negative gap. Why? Because I'm having a loan. Okay. So if interest rates are going to come down, I'll benefit. However, my loan is what? Fixed. Right? Fixed rate. That means even if the interest rates are going to come down, I have to pay same rate. Right? Even though the market interest rates fall, I've agreed with the bank that I'll pay at 8%. So what is happening now? My expectation is my analysis is yield curve is coming down, so the interest rates will come down. Why should I pay a fixed rate? So what I do is then I go to another financial institution. Okay, I enter into an arrangement. I enter into an arrangement where, okay, A pays FI, L plus say 1%. What is L? LIBOR. Okay, and FI pays A 8%. What is 8%? The floating, the fixed rate. Are you getting this? FI will pay. To whom it will pay? It will pay to A. Okay, FI pays 8%. Okay, this will come here. So what is happening now? A pays bank how much? 8%. A pays FI how much? L plus 1%. Now let's say L is 7%, or let's say L is 6.5%. Okay, at that point in time, L is 6.5%. Okay, so A pays FI how much? Minus 7.5%. A pays bank minus 8%. Why? Because I am paying negative. So A receives from FI. A receives from FI how much? 8%. So net 7.5%. Right? Because of this arrangement. Okay? This is called as interest rate swap. What are you doing? You're swapping your interest payments. Okay, in exchange of another, you're swapping your interest payment in exchange of another interest payment. That is okay. You're not taking, okay, so this is a swap. This is not a loan. Let us understand. This is a different transaction. Here it is a loan, you place collateral and all those things. Here if the loan is let's say 1 million, 2 million, 10 million, what will be the amount, and that you will pay interest. Here and bank will pay that loan. Bank will pay that 1 million, 2 million cash, okay, whatever it is. Here, okay, it is only a notional that is agreed upon. On a notional, you calculate the interest. Okay, A will not receive from FI, it will not receive millions of dollars. Okay, it will only say on a notional, you pay me 8%. On the same notional, I'll pay you L plus 1%.
Over this case, financial institution is a loss.
Ah.
I'm giving you money, still I'm incurring.
But after some time, if the L increases, the financial institution will get.
So it is not like that. Okay, in this case, financial institution may not make money, or you never know it makes money. How? Financial institution, it is not only I am the only customer. Like me, there are thousands of companies. Okay, like me, there are thousands of players, and not that all the 1,000 players will expect the interest rates to go up or come down. Right? You are coming to me, you are company, I am financial institution, you are coming with this requirement. He will come with the opposite requirement. Right? In a market, all type of people are there. In a market, everyone will not expect the same thing. Correct? If everyone expects the same thing, market will not be there, right? In a market, you have buyer as well as sellers. Right? If everyone wants to buy, why will the seller sell? Seller will also want to buy, right? Seller will not sell, right? Right? So think about equity shares. If everyone wants to buy, prices are going, I want, the stock is good. If someone is buying, someone is selling, right? Why is that other person selling? He has a different perception, he has a different requirement, he has a different need. Right? So, same thing. There are multiple players, there are thousands of players. So, the financial institution will know how to hedge its exposure. Okay. Did you understand? This is interest rate swap. This is one way through which I can hedge my exposure in terms of interest rate. Did we understand this? Anyone has any doubt? Srinidhi, following?
Yes, sir.
So here it will the notional will not be exchanged. Okay, the notional amount, the underlying loan amount will not be exchanged in this case. Okay, what will be exchanged is only the net, not even 8% or 7.5%. What will be exchanged is only this 0.5%. Okay, after every 3 months. Now this could be 3 months LIBOR, 6 months LIBOR, whatever it is, periodic reset. We call it as. So this is a different transaction. Here, company A will pay to the bank so much. Okay, this is a separate transaction. And this financial institution could be the same bank also. Right? Within one bank, you have different desks. We call it as different desks or different functions. Right? One bank can have a commercial lending bank division, which is this, where they lend. The other bank, the other division could be trading derivatives division, okay, FX division, rates division, where they may be doing all this. Okay, so interest rate swaps. Okay, then we have something called as forwards and futures. You have seen, right? So same thing, we have something called as forward rate agreement, FRA, where the underlying, here the underlying is interest rate. Okay. Like you have seen forward, we talked about Epson projector. He said I'll buy a forward contract to sell the Singapore dollars or to buy the Singapore dollars, something like that. The underlying was the currency. In this case, the underlying is interest rate. What is this forward rate agreement? Basically, I am entering into a forward contract, okay, to freeze an interest rate. I'm entering into forward contract to freeze an interest rate. Okay. If I'm buying FRA, that means I've taken loans. Okay. If I'm buying FRA means I'm taken loans. Okay. That means I've taken loan I have a net negative gap. Okay, so I have to pay interest. Okay, and my interest rates are, let's say, increasing, decreasing, whatever it is. I want to freeze the interest rate. Okay, so what I do is, let's say I'm going to get some money after 3 months. Okay, and I want to invest that money. Okay, but I feel the interest rates may come down after 3 months. Are you getting it? I'm going to get money and I don't have any requirement of money after 3 months. So that means that will be a surplus money that is going to be available. I'm investing that money. I want to invest that money, but I feel after 3 months the interest rates will come down. So let me freeze the interest today. So I'm entering into an agreement to freeze the interest rate, which is called as forward rate agreement. So what I do is I enter into an agreement. Okay, let's say after 3 months, I will get some money and I will not need that money for, let's say, next 6 months. Okay, so I'm entering into something called as 3/9 FRA. What is this 3/9 FRA? Three x 9 FRA. What does this mean? That means today I am entering into a forward rate agreement. Okay, to buy an FRA or sell an FRA, as the case may be, after 3 months. Okay, for a period of 6 months. How do I say 6 months from here? 9 minus 3. So 3/6 means what? 3 months from after 3 months. Okay, so what I do, I freeze the interest rate. That I am agreeing with the other person that after 3 months, okay, I will take a loan or investment and this will be the interest rate. Okay, so let's say I'm entering into this 3/9 FRA at 5%. Okay, that means I will invest after 3 months at a rate of 5%. Okay, now after 3 months, let's say after 3 months, you are getting money. Okay, at that point in time, the spot rate is 4.5%. But what rate you have agreed? 5%. Now here you are investing. So what is your gain? 0.5. That FRA will close. That FRA will close after 3 months. The other person will pay you 0.5%. Okay, FRA is not there for 9 months. FRA will close in 3 months. That agreement will close in 3 months. The other person will pay you. Either other person will pay you or you will pay the other person. The difference. That's all. So what will happen now? Let's say after 3 months, money is coming in. In the market, the rate is 4.5%. I'm investing for 4.5%. The bank is going to give me only 4.5%. Balance 0.5% where I'm getting from the other party. Getting it? Similar is for the loans also. Read this. So here he wants to borrow. Cash deficit. For 5 minutes. Calculate the interest payable in 2 months' time. The market rate is 7% or 4%. Yes, how much interest payable if the market rate is 7%? Done. Should not take so much of time. What is the FRA rate? 5%. Okay. What is the notional? Notional value. 8 million is the notional value. Right? So FRA rate is 5%. The market rate is how much? So you are going to borrow when? Here. Because you are telling I'm expecting a cash deficit of 8 million in 2 months' time. Where are you currently? You are here currently. You are expecting that on 1st January we will need 8 million. Okay, and we are having a cash deficit, so we are going to borrow so much. Okay, but my fear is in these 2 months interest rates will increase. I don't want to borrow at a higher rate. Okay, so I am entering into an FRA 2/5. Okay, which will give me protection for 2 months. Okay, and thereafter, basically, I'm agreeing on a 3-month rate after 2 months. Okay, so the 3-month rate after 2 months is 5%. They're telling always. Okay, we saw this in your FX also. Bank will always buy at a higher pounds and sell at a lower pounds. Okay, accordingly, you should fix the rate. So here we are telling borrowing rate is always the highest. So 5%. Right? So I have agreed to borrow at 5%. What is the market rate? Market rate is 7%. That means under FRA, I am gaining or losing. Because of FRA, I am gaining. Why? Because market rate is 7%, but I have agreed at 5%. So 2% into 8 million is a gain. Okay, it is 160,000. Okay, and in the other case, how much is the loss? 1% is the loss. Why? Because your FRA rate is 5%, but market rate is only 4%. When will you make this payment? On 1st January. Or there are different arrangements. Okay, it can be paid after 3 months also. But it will be whatever it is, will be calculated and decided on 1st January. You will know it on 1st January. Okay, because on 1st January, spot rate will be identified. Okay, the spot rate is 7% or 4%. Accordingly, who is liable and who is not liable will be determined. Okay, did we understand this? So interest rate swaps, forward rate agreements. Okay, then. Okay, so the way forward rate agreement works, okay, it is a forward rate, right? The underlying is your interest rate. Okay, so something similar we have futures, okay, which we call it as interest rate futures. Okay, now what is the difference between forward and futures? Hmm? Okay, so similar to what are forwards, it's just that they are exchange traded. Okay, they are standardized. They're not customized. Forward rate can be customized. You can enter into forward rate agreement 48 days from now, 36 days from now. Okay, 39 days from now. But futures are not like that. Futures will have fixed maturity, 30 days, 60 days, 45 days, 1 month, 2 months, 6 months. And the notional will also be fixed. The rates will also be fixed. Okay. Now, I have an exposure of, let's say, 8.75 million. Okay. Futures are available only in terms of 2 million buckets. 2, 4, 6, 8, 10. So either you take 8 million, either you cover 8 million or you cover 10 million. Bring it. Just giving an example. Like this, the notional buckets could be different. Okay, the contracts could be different. My exposure is 8.75 million. You cannot get futures for 8.75 million. You may get it for 8 million or 10 million. Okay, so that is one factor to be understood. Second is this 8.75 million is, let's say, matures in 50 days. Okay, but futures contract is for 2 months or 1.5 months, either 45 days or 60 days, 2 months or 1.5 months, right? So now what is happening? Are you able to cover your exposure fully, properly? You're not able to cover fully and properly. Why? Because my exposure is 8.75 million. I'm able to take another exposure for 8 million or 10 million, but not for 8.75 million. First point. Second point, the interest rates, right? The maturity is also a little different, right? So this creates a risk. This creates a risk, which you call it as basis risk. Okay? Where you're not having 100% hedge. Okay? You're not covering 100% properly. Okay, I'm not able to do it, not able to cover fully or properly. So what happens? The interest rates that are moving in the real market, okay, the underlying interest rates and the futures change will be different, right? You are having one exposure of 8.75 million, but through the futures, either 8 million is available or 10 million is available. So if you take both of this, your exposure is not getting offset. It is creating additional exposure, okay, that is exposed and that may attract risk. So that is why we are telling you're not covered 100%, and this is called as basis risk. That means to the extent where you're over covering or where you're under covered, you may incur gains or losses. Okay, are we getting this right? So we'll take a break now, okay, and come back and continue to see how interest rate futures work. And there are one or two more. With that, we'll close interest rate risk. Then we'll move to another topic. We'll take a break and come back. Okay, so let us continue further. So talking about two aspects. One is in terms of the basis risk that is there. And basis risk is not only for interest rate futures. This is a general term. Okay, this could be there where 100% hedge is not possible, which is there in a lot of cases. Okay, so where you're not able to cover 100% of the exposure exactly, then that is a basis risk. This is there in FX also. This is there in interest rates also. This is there in futures also in a lot of different cases. Okay. Now, how this interest rate futures work? Okay, much similar to FRA. Okay, it's just that it is closed by taking an opposite contract. Okay, even other futures also, like whatever futures you have seen, all the futures are closed by taking an opposite contract. That means if I'm having a buy contract, I'm entering into a futures buy contract. Okay, to close this, I will enter into a sell contract, so that my position is neutral and pay out and settle out the difference. Okay, so the same case here also, I will, if I'm talking about borrowing a loan, if I'm talking about borrowing, then I will sell futures. Okay, why do we sell futures? I'll sell the interest rate futures. Why do we sell the interest rate futures? Okay, what we are essentially selling, we are selling the payments. I'm going to make the payments on the loan, right? So I will sell the futures. That means I will enter into an interest rate futures contract to sell the same. Okay, and lock the rate. Okay. Then on the day, like say this could be 3 months from now. Okay, on the spot date or on the maturity date, I will enter into a contract to buy futures. So what happens? My position is neutralized. Neither I have to. So as I said, all these derivative contracts, okay, all this hedging instruments, hedging contracts, we are not dealing with the principal amount or the loan amounts. Okay, we are only talking about notional amounts. Okay, we're talking about notional amount and we settle the difference. Okay, so if I'm entering into a forward contract also, even in a forward contract, and let's say I'm entering into a forward contract to sell this water bottle. Now there are forward contracts where delivery is taken, meaning to say I will deliver this water bottle. But in the financial world, whether you are entering into forward contract or futures contract or whatever it is, you will not deliver the underlying. Neither you will take delivery of the underlying, nor you will do the delivery of the underlying. You will only take the differential calculation. You will calculate the differential amount and you will take it. For example, if I am covering an FX exposure, I'm having an open FX exposure to make the payment for this projectors, right? I will not take the dollars from the bank. Okay, I will take the differential calculation. Differential calculation will be done, and if I'm gaining, bank will pay me in equivalent INR, and if I'm losing, I have to pay the other party equivalent INR. Okay, and that gain or loss is my gain or loss because of the hedge, and on the other side, I'll make the full payment on the spot basis. Are you getting it? So I'm not going to take the delivery of the notional, neither I'm going to give the delivery of the notional. Right? So here everything is basis. The notional is used only for calculation. That is why we call it notional. We don't call it real. Why? Because it is not getting exchanged. So same way here also the borrowing, okay, or the futures contract that you're entering, you're not going to borrow money, right? You're only, this is only used as a means to calculate the differential amounts. Are you getting this? So when I say I'll sell futures 3 months from now, right? I'm going to, that means I'm intending to borrow, right? I will freeze, okay? I will freeze the rate at which I'm going to sell. So this rate will be frozen today. Okay, this rate will be frozen today. 3 months from now, I'll make a payment on the futures contract because I've sold futures. I'm selling the interest payments. I'll make the payment on the futures contract. Whatever is agreed rate. Okay. And so this is the payment that I'm making, and whatever is the spot rate, on that basis, I will receive the payment net. I'll receive the payment on a net basis. Okay. So similar to FRA, this also works. And your transaction with the bank will be separate. Wherever you have taken loan or you're going to take loan, that is a separate transaction. Getting it? Okay. So this is about your interest rate futures. Okay. Futures contracts are generally closed. Okay. By taking opposite positions. That means there are always, you are entering into two contracts, one today and one at a later date, opposite contract, so that the transaction is closed and the differential is settled. Interest rate futures, interest rate swaps, forward rate agreements. Okay. In principle, these three are your hedging instruments as far as interest rate risks are concerned. Then we have other stuff also. We call it as interest rate caps and floors. Okay, there are a lot of this stuff. We'll quickly discuss what interest rate caps and floors are. Wherein you enter into an agreement, okay, where you're capping the interest payments. You're capping the interest payment. You're telling that I'll pay the interest, but only at this level. Okay. Beyond this, I will pay, meaning to say I'll pay in this agreement, but if the interest rate goes beyond this, then I will get the offset from this interest rate cap agreement. Are you getting it? Similarly, interest rate floor, where I will receive at least this level. The interest rates fall down, goes below this level, I should receive at least this level. So when will you use cap and when will you use floor? When you borrow, you will use cap. When you lend, you will use floor. Floor is at the bottom, minimum at least so much. Okay. So that is one. So there are, I think, one or two more are there. You can go through this. Okay. Most importantly, understand swaps, FRA, then interest rate futures. Okay. Mainly FRA is what calculations are required. Even swaps also, calculation is very, very simple. Okay. One thing in FRA, okay, it should be for the amounts that you are calculating, it should be for the period that we are talking about. For example, this 5% is what? Per annum, right? We are calculating for how much period? 3 months. So you should do that differential calculation. For example, 2% we said, right? 7% minus 5%, 2%. 2% into 3 by 12 will be the calculation. Okay, so this is something, a universal fact. Wherever interest rates are mentioned, any percentage is mentioned, by default it is per annum basis. Okay, so in your calculation you should see that, okay, for what period you are calculating, accordingly do the calculation only for that particular, that corresponding period. Okay, so this is about interest rate risk chapter. Go through this. Okay, a good chapter again, important from a practical perspective also.